All right. Good afternoon and happy Friday, everybody. It is my favorite time of the week, my weekly wrap-up live stream, and we got a fantastic show for you today, guys. I saw something this morning that had me shaking my head. The name of the game is Extend and Pretend. It's been going on all over the market. The whole market is sitting here like, you know what? We have this asset on our books, and it's worth so much money because we paid so much money for it. And even though we know we can't sell it for what we paid for it, we're still going to pretend like it's still worth that. Kind of like that guy who bought Beanie Babies for $100,000 20 years ago. Even though the things are selling for 50 cents now, he's like, I've still got a $100,000 asset because I paid $100,000 for that Beanie Baby. I'm just going to keep extending my time frame and pretending it's still worth what it really isn't worth. And that is going on all over Wall Street right now. Case in point was this morning, we got an announcement from this private equity firm, Ninepoint Partners. And Ninepoint Partners announced that they are suspending cash distributions from 3 of their private credit funds. These things are so great. 8% returns, 10% returns. Oh, they're great investments. Private credits. We're pretending we're a bank. We're making these loans to these companies, and we're promising these great yields. The problem is, these companies, they don't make money. Yeah, there's that problem again. Companies not actually making money. We were just talking about that this morning. Dell, excuse me. These companies don't make any money. And so this Ninepoint Partners fund is just saying, you know what, guys, we're not going to be able to pay you anymore. But don't worry, this is still a fantastic investment. 3 of these funds were frozen on the same day. And I did a little digging into this Ninepoint outfit today, and they should not be having problems. Because I found this website that did a blog post. This outfit has been tracing Ninepoint and this Third Eye Capital that they're partnered with for one of these funds. They should have plenty of liquidity available to them because they had hundreds of millions of dollars worth of loans that were scheduled to be repaid over the last few months. And if those loans really were repaid, well, then how come they don't have any liquidity? How come they don't have enough money to pay their investors the interest that they're owed? Well, maybe it's because they didn't actually get repaid. Maybe it's because they just did their extend and pretend game. And when I went and I looked, it turns out some of these companies in these funds actually owe money to each other, not just owe money to the investors in these funds. All of these companies that don't earn any money, that were supposed to have been killed by higher interest rates, right? That was the whole point of this rate hiking cycle and this tightening cycle, was to restrict liquidity so that zombie firms would die off. And yes, it would be painful for people, but we would be left with a healthier economy. But instead of these companies failing due to higher rates, Wall Street discovered this whole new rug to sweep this crap under called private credit. And so they've just taken this debt and instead of these companies being killed by these higher borrowing costs and these higher interest rates, they're parking them in these private credit funds where they use something called PIK, or payment in kind. And basically, instead of having to pay interest on these loans that they made, they're actually allowed to just make the principal bigger. Oh, we owe you 8% interest? Well, we don't have 8% interest, so we owe you 8% more money now. Oh, great. What a great investment that is. The problem is these companies don't make any money, and so it doesn't really matter how much money they tell you they owe you. If they never earn any money, then they're never going to be able to pay you back. And we're starting to realize that with Ninepoint Partners this morning. And by the way, this is not the only case of extend and pretend. Keep in mind, the way we got out of the banking crisis last March was pretty much extend and pretend. The banks had all of these losses, unrealized losses on U.S. treasuries because the interest rates went higher. Those bonds were worth less money. And so the banks just pretended they're worth more. They changed the way they account for them. Instead of assets for sale, they changed them to held to maturity. And we're just going to sit on these bonds for 10 years, 20 years, 30 years and pretend they're still worth more than they're actually worth. So the banks are doing the same thing. And then you've also got real estate investment trusts like Blackstone's BREIT, which is finally now starting to meet investor withdrawal requests. But for a year and a half, the BREIT pretended that they just said, you can't withdraw your money. Oh, don't worry. We've got all these real estate assets. And instead of selling these assets to pay people back the money they were trying to withdraw, Blackstone just said, no, you can't have your money back. We want to preserve liquidity. Translation, the crap that makes up this fund isn't worth enough to give you your money back, but don't worry, your money's safe. Wink, wink. Starwood's doing the same thing in S-REIT. Starwood's actually in even worse shape than Blackstone is. And this is going on all over the commercial real estate industry. There's an article in the Wall Street Journal just this morning that the collapse of commercial real estate is clobbering pension funds. Gee, if only somebody had been warning for years and months that all of this garbage had been parked in pension funds and that people need to get on the backs of their pension fund managers and start demanding that they unload this crap before it's too late. Well, it's too late now. You're never going to be able to unload this stuff. Price discovery is almost upon us. It's not quite here yet. But again, the pension funds, they're sitting on all these towers. And even though we've got story after story of these towers losing hundreds of millions of dollars, most of these funds are still sitting on their commercial real estate loans, claiming that they're still worth what they paid for them, when we all know that's not the case. They've just got their eyes covered up. They've got their fingers in their ears. They're just the monkeys. See, speak, hear no evil, extend and pretend. And that's to say nothing of what private equity is doing with net asset value loans. Private equity has been, for the better part of a year now, borrowing money to make it look like these funds are generating return on investments. And then they're taking that borrowed money and they're paying it out to their partners, saying, oh, here's your share of the profits from these companies. Well, gee, when you sell one investment product to raise money to pay the returns on a prior investment product, don't we have a term for that? Oh, yeah, Ponzi scheme. That's what we call that, a Ponzi scheme. It's not quite a Ponzi scheme, but it's pretty close to a Ponzi scheme, what these net asset value loans are doing. And the SEC is starting to sniff that out. They're starting to dig into that. And, you know, I'm just sitting here and I just have this hope that maybe one day some financial Columbus will sail across this ocean of BS, extend and pretend, and finally discover price. Maybe we'll finally learn what this stuff is worth. Extend and pretend does not solve our financial problems. It just sweeps them under the rug. And people are continuing to have their retirement accounts invested in this garbage. Pensions are buying this stuff hand over fist, guys. This is your money, your retirement. This is grandma's nest egg is being parked in this while these Wall Street clowns pig out, pay themselves huge management fees and commissions on this crap. And the problem keeps getting worse. And I get a lot of emails from people and comments like, Jack, you almost sound like you're wishing for a market crash or you want a market crash. Look, nobody wants a market crash, but we need a market crash. The longer this goes on, the worse the pain for innocent people gets and the more money these a-holes on Wall Street make. And that's why, you know, call me a doomer, call me whatever you want. We need price discovery before it gets any worse. But in the meantime, Wall Street is just subscribing to the infinite wisdom of the great investment gurus, Wilson and Phillips. If you hold on for one more day, the Fed will go your way. That's it. They're just sitting there pretending, hoping the rate cuts get here in time before everything blows up. Well, they didn't get here in time for Ninepoint Partners this morning. And with that, why don't we shrink my big melon of a head? Let's say hi to my man, Mish, the mod, who is in the house. How are we doing today, Mish?
I'm doing pretty good. You know, somewhere along the way, we got this in our head that we can't let any companies fail. And I really think we got that mindset around 2008. You know, it's I hate picking on people, but it's this Bernie Sanders kind of frame of mind that nobody can fail in business. And it's going to hurt the economy in the long run because these zombie companies never die. They just, you know, continue limping along.
Yeah, and you know, you're right. It was, in my opinion, it was around 2008 when the moral hazard really became institutionalized, almost legislated into law. Right? That was what happened in 2008. All the people who made things so bad never felt the pain of it. That pain got socialized. And, you know, yeah, hey, Bernie Sanders, the socialist, looks at that and says, hey, this is a reason to say capitalism doesn't work. And this is why me, Bernie Sanders, I should have more power. Well, no, when losses are socialized, that's not capitalism. And, you know, the socialists and the communists, I warn about this all the time, too. They look at moral hazard, which is a very anti-capitalist philosophy. It's definitely not free market. And the socialists and the commies are looking at this saying, see, we need to embrace socialism and we need to embrace big government because look at what Wall Street is doing. Wall Street could not do what they're doing without big government's help. And so the solution isn't more communism and more socialism. The solution is more capitalism every time. But again, the next time it blows up, you're going to see more Bernies come out of the woodwork. And you're right on the money there, Mish. By the way, where are you at right now, Mish? What's where are you in your travels?
So I am sitting in a hotel near the London Heathrow Airport. So that's west of London. I did get to a pub earlier, or actually yesterday, had a nice pie and mash with the Guinness. And the Guinness is just so much better here in the UK than it is in the States. Yeah, it's day and night. And
is it a different?
Yeah, tomorrow I'm getting on a plane going to Philly.
That's right. Mish is going to be in my neck of the woods starting next week. Is it Guinness different in London? Do they make a different beer out there? Or?
So any food or drink that you drink or eat is different on regionality. So if like the Mountain Dew fans out there, if you drink Mountain Dew in Dubai, it tastes totally different than it does in the United States. I won't say what we called it, but so any country you go to and you drink your favorites or eat your favorites, they're going to taste different. There's St. Pauli Girl in Australia is a great beer in Australia. In the United States, it's not good. It's just that regionality. Yeah, Renaissance snobs is talking about Coke in Mexico. Mexican Coke is a shiznit.
A cola, right? I don't want to get flagged by the algo here because when you say Mexican Coke, you're going to have to be more specific, I'm afraid.
Yeah. No, the drink, not the South American energy source.
And call me skeptical. I got to be a little skeptical. I'm going to go out on a limb and say that Mountain Dew is radioactive horse piss. I don't care what time zone you're in. I'm just going to throw that out there. That stuff is garbage.
when you're doing 5 on and 10 offs, you got to drink something. That was the days before Monsters. You had your choice between 5-hour energy drink, coffee, and Mountain Dew. And I don't drink coffee.
Oh, I love me some coffee. I'd hook it up to an IV if I could. But, I could sit here and talk about drinks all day. We got a market to get through, and we got a lot of stuff to talk about with people's retirements this afternoon. So let's get right into it, shall we? The S&P 500 is currently, I don't know what I just did. I clicked on something. Here we go. The S&P, just barely in negative territory here, down 1 point. It was down quite a bit at one point today. We were up pre-market on that slightly lower than expected inflation news, ever so slightly, and then we sold off at the open. Looks like a little bit of a bump here. Now, the S&P on the long-term chart, this is now looking at daily candles going back to the start of the year. Interesting tidbit here. The S&P got near its 50-day moving average today and caught a pretty good bounce off of that. So that's a pretty good technical indicator that the S&P might be heading higher here. Although overall, the S&P had a pretty lousy week. This was the first negative week in a while for the S&P here, down 4 days in a row. We had a decent, all week it was down because it was a 4-day week. So yeah, we were down every day this week. Are we going to close in positive territory? I don't know, but we're close. Meanwhile, the Dow is looking great this afternoon, up 293 points or 0.77% higher at 38,400. Now, looking again at the long-term chart of the Dow here, Dow long-term doesn't look so good. We lost the 50-day moving average a few days ago here. Now, pretty far down below that. We peaked in the Dow just over 40,000 a couple of days ago on the 20th of May. We sold off almost 2,000 points since then, but having a pretty good day today here. Now, the Dow is rising by a few hundred points. Check out the NASDAQ, down 156 points at 16,581 today. Now, it's the last day of the month. When I see the Dow up big and the NASDAQ down 100 plus, that is telling me we've got some end of the month portfolio rebalancing going on here today, selling the big tech names that are high flying, buying a little bit of value in the Dow. So it looks like that's probably what's going on a little bit here. Some of the AI stocks are selling off. Meanwhile, some of the retailers are doing a little bit better today. Looking at the NASDAQ, though, the NASDAQ's still got quite a ways to go. Pretty big gap between the 50-day moving average and the NASDAQ here. So we'll see what this looks like at the start of the month next week here. I'm not reading too much into this sell-off in the NASDAQ. Doesn't really look like a top to me, although the NASDAQ is so top-heavy, it should be heading lower. Meanwhile, the dollar recovered pretty much all of its losses from the morning. We saw the dollar fall on that inflation report this morning, clawed that right back after the open. Now we're sitting here down 5 basis points at 104.67. And the bond market, it looks like we got mostly lower yields here. The 30-year is down 3.5 points at 4.649. The 10-year at 4.510, down 4.5 points. The 2 is at 4.885. That's also down 4.5 points. And the 1 month is at 5.369, pretty much 5.37, where it's been for a while here. Now, I wanted to look at the 10-year Treasury chart, a little bit of a long-term chart. Again, these are daily candles going back to the start of the year. Of note today, look where we bounced right on the 50-day moving average for the 10-year Treasury yield. So that's interesting. We were selling off pretty hard this morning. The yields were falling on that inflation report, but we did catch a bounce right around the 50-day moving average. That tells me that this uptrend since the start of the year is still intact, and the 10-year still wants to go higher here. Now, commodities not having such a good day. Gold, spot gold is at 23.21. That's down 21 bucks, almost 1% lower here. Spot silver at $30.22, down 94 cents or 3% lower today. Silver's getting clobbered here. Copper is down 1% for July copper futures. July platinum futures are down 0.5%. September palladium futures getting clobbered, down 4.6% here. And crude oil is down again, 77.09 for July WTI futures. That's down about 82 cents or $1.05. I wanted to show you that. Oh, go ahead, Mish.
Yeah, I was going to say I read somewhere today that they're starting to call for $900 on palladium, so there may be some more pain there.
900 in palladium. Okay, is that autos you think is sending palladium lower?
I do, and I think that's that auto thing we talked about the other day.
Yeah, I'm hearing a lot about the car market not looking so good, about rising inventory levels. And I think in the next week or two, I'm going to talk to my buddy Tommy. It's probably time to bring him back on the channel from Car Concierge Plus to see what he's seeing in the car market, if he's seeing any trends change. Tommy buys a lot of cars, so he's got pretty good access to data there. Switching over to the silver market here, I wanted to show you this trend. It looks pretty ugly there, guys. That's looking a little bit like a double top there in silver. Although that $30 level is still holding for the moment, where above $30, a weekly close above 30 would be encouraging. But right now we need a turnaround here. That's looking pretty ugly. That top is a little worrisome. I've got Bob Coleman coming on the channel on Tuesday next week to talk about the silver market. So I'm looking forward to that one. And Bitcoin is also not looking so good this morning, down $844. It's not this morning anymore. Sorry, guys. This afternoon, trading at 67,492 on Coinbase. Bitcoin's been pretty range bound here for about a week and a half. All right. Now let's, before we get into the story about Ninepoint Partners, I got to thank you. I got to say thank you, Ashley Walton. Appreciate the super chat and support of the channel. It says, what about businesses that 100 price to earnings ratio? How is this logic even allowed, let alone credible, e.g. Uber? I can tell you, the only time a 100 PE is even remotely justified, you got to have some serious growth. All right. You've got companies that aren't profitable. I mean, they're technically their PE is, error syntax. They don't have any earnings, so you can't divide by 0. Growth companies, you can justify 100 PE. All right. If the company is growing hand over fist, big double-digit year-over-year growth in revenue, and, then I could see a 100 P to E. But I agree with the sentiment of your comment, though, Ashley, wholeheartedly. I think the whole market is just way, way overpriced. The S&P PE is way too high. I don't think these growth numbers big tech is putting up are going to be sustainable. I'm surprised they've been sustained as long as they have. So I do think there's a price to earnings reckoning in store for the market. But this extend and pretend and, this mother of all pump and dumps that's going on in artificial intelligence, I think these PEs might be here for a while. But I agree with you wholeheartedly. I do think this market is very overvalued. Again, if you've got really good, sustainable, tangible growth, not stupid round-tripping accounting gimmicks, only then would I say a PE that big would be justifiable. Thank you very much, Ashley. I appreciate the super chat and the support of the channel. And let's get on to this story here. This is the one that really caught my attention this morning. Canada's Ninepoint halts cash payouts on 3 credit funds. Guys, pay attention. If you've got a pension, or if you've got a relative with a pension, or, grandma's in retirement, or your parents are retired, Pay attention to this, guys, because pension funds have become the dumping ground for Wall Street's crap. And they have parked so much of these garbage zombie companies and commercial real estate into pension funds. And stories like this are starting to play out across the market. Canadian investment manager Ninepoint Partners is temporarily suspending cash distributions in 3 of its private credit funds. By the way, this is the second time Ninepoint has done this in 2 years, but who's counting? Unit holders of funds with about 2 billion Canadian dollars, about $1.5 billion US, of assets won't be able to receive cash payouts. In order to preserve the fund's liquidity, the firm will revisit the decision in the third quarter. After reviewing our various liquidity options, Ninepoint Partners and our sub-advisors have determined that the best path forward to preserve liquidity and balance long-term goals of these 3 affected funds is to redirect future distributions into additional units rather than cash distributions starting July 1st. Well, it's very nice of them to decide the best use of your money is to not give it to you. How generous of them, isn't it? The affected funds are the Ninepoint-TEC Private Credit Fund 2, the Ninepoint Alternative Income Fund, and the Ninepoint Canadian Senior Debt Fund. Toronto-based firm, which oversees about $7 billion of assets, is not winding down these funds, according to the statement. Investors will continue to have access to the ongoing benefits, whatever those are, of being invested in private credit as we remain focused on ensuring the sustained performance and stability of our current portfolio. The largest of these funds, the Ninepoint-TEC, which reported $1.2 billion in Canadian assets at the end of 2023, it makes asset-backed loans to companies that may have difficulty obtaining finance from other sources, and some borrowers have the option of paying interest payments as payment in kind rather than cash, according to the fund document. Now, maybe, I'm just throwing this out there, guys, maybe there's a reason that these companies have difficulty obtaining financing from other sources. Maybe it's because these companies suck and they don't make money. Did anybody ever think about that before they put their money into this fund? Maybe there's a reason. You know, it's like you're renting a house to some guy and he's like, yeah, nobody will rent to me. Well, maybe there's a reason nobody will rent to you. Maybe it's because you don't pay your rent. Maybe it's because your credit sucks or you trashed the last 3 houses you rented. Maybe that's why nobody will rent to this guy. These are the questions you ask before you send them your money. And that payment in kind interest, put a pin in that. We're going to get to that one in a minute. The Ninepoint Alternative Income Fund, which is around $600 million Canadian, has the bulk of its loans to middle market companies in the US and Canada. It normally targets payouts to investors of 10% to 12% of the average net asset value in a calendar year. And guys, when you see returns like that, 10 to 12% interest rates, all right, that needs to be a warning sign to you. Anybody who's paying out that kind of interest, it means they're desperate for funding, probably because nobody will loan to them. Again, you've got to ask why. Now, that payment in kind phrase there, that's interesting in that one paragraph. Some borrowers have the option of paying interest as payment in kind rather than cash. It's almost like that scene in Dumb and Dumber. Oh, don't worry, those are just as good as money. Those are IOUs. Oh, you see this one here, $280,000 for a car? Might want to hold on to that one. Yeah, that's what these funds are accepting instead of interest payments. And I did a little bit of digging here. Private credit has a new workaround to allow borrowers to defer interest payments. This was just yesterday in Bloomberg. I'm telling you, this stuff is all coming to a head. A controversial lending structure that lets companies pay interest with more debt is getting a new spin from private credit. Payment in kind lets borrowers make some or all of their loan interest payments by increasing the principal amount rather than using cash. That flexibility is in high demand as the Federal Reserve's policy tightening cycle has made it more difficult for heavily indebted companies to service their debt. Private credit funds are well positioned to provide PIKs or payment in kind loans, and they've often used them to beat out banks when competing to provide financing to companies. So these companies that are taking these loans from these private credit, they're not even paying the interest on these loans. The balance on the loan just gets bigger over time. Oh my God, this stuff is dog shit, guys. This is crap debt. No wonder they're freezing cash distributions. They don't have any cash because nobody's paying interest on the loans. The loans are just getting bigger. Extend and pretend. And I got to send a shout out to opmwire.com. I've never heard of this website before, But I went digging into Ninepoint Partners today, and I found a whole bunch of stuff. This OPM wire company has been all over Ninepoint Partners for about 3 years now, apparently. It's the first I heard of them today. But Ninepoint and Third Eye gate their fund again, stuck in the middle with Third Eye's half-seeing king. Ninepoint announced this week that the Ninepoint-TEC Private Credit Fund 2 is gated, meaning you can't have any money back. Ninepoint also said that all distributions for valuation dates on and after May 31st, 2024 will be automatically reinvested. There's that payment in kind. The balance gets bigger. No interest payments. In our view, these are signs that the fund liquidity is extremely poor. Subscriptions to the fund will also be suspended. Now, these guys have been following them for years. On November 24th, 2021, we initiated our coverage of the Ninepoint-TEC Private Credit Fund with a rating of POS. And if you're not familiar with this term of art, please ask an industry expert. These guys have a sense of humor, too. This is the second time that Ninepoint has gated the Third Eye Capital Fund since then. So this has happened before, guys, these Ninepoint guys. Now, they go on, they talk about the history. Again, I encourage you guys to check out this opmwire.com website. They've done an excellent job researching what Ninepoint is doing. But we're going to skip down to about halfway down this article here where it really gets juicy. The Ninepoint-TEC Private Credit Fund 2 had $606 million of loans at fair value maturing in the second half of 2023 up to April of 2024, according to the fund's interim financial statements as of June 30th, 2023. That's available in the appendix of this article. And they're showing here these 4 loans that were in this fund here. This $137 million fund to a company called Gogel Holdings, $292.1 million to Trilliant, $71.3 million to Protair-X, and $105.3 million to this company, Ametis. So all in all, $605 million of loans were supposed to have been paid back to this company between September and April of this year. So if they just got paid back $605 million, how is it that these guys don't have any liquidity to pay out their interest payments? Well, maybe they weren't paid back. Maybe they just extended and pretended. Maybe nobody's actually paying any money at all. Maybe these are just zombie companies that are just sitting there and the loans are just getting bigger and bigger at your expense if you or your pension fund are invested in these things. But it gets worse. Beyond the loans maturing, NTEC2, the name of this fund, also had 3 facilities with Conifer Energy with a total fair value of $314 million. Now, these facilities don't have expiration dates, but are described as on demand, implying that NTEC2 can call them at their discretion. So there's another $314 million of debt that this fund has lent out that they could demand repayment at any time. So add all of this up, these 4 loans maturing over the last few months or so, plus this $314 million of on-demand credit. These guys should have $900 million of liquidity available in their fund. And, you know, they're saying here, this is 75% of the net asset value of this fund as of some of their financial disclosures in 2022. So how is it possible that Ninepoint has to freeze payments if they're supposedly having 75% of the fund's net asset value should be available to them almost immediately? Why are they freezing distributions? Something is up with the companies in this fund. And so I went and did a little bit of digging into some of these company names here. Let's talk about this one right here, this Ametis fund that supposedly paid back $105 million on April 1st. There's a lot of liquidity that should be available right now. Here's Ametis stock, ticker AMTX. It's down 2.25% today. Now, my first thought when I look at this chart is this thing trades like a pump and dump. This stock was trading at $25 a share back in 2021. Now it's trading at $3.48 a share. So, I mean, this company is garbage. And then when you go and look at the financials, it gets even worse. Let's check out the financials of this company. We're going to go to annual on their income statement. When you scroll all the way down, where's the free cash flow? Let me get that free son of a gun. Where's the cash flow statement? Here we go. Cash flow. Here we go. Free cash flow. In 2020, their free cash flow was negative $16.8 million. In 2021, free cash flow, negative 47.3 million. 2022, free cash flow, negative 62 million. 2023, free cash flow, negative 19.2 million. And total to date for this year, or the trailing 12 months, negative 14.2 million in free cash flow. This company has not made money ever. I mean, the free cash flow statements only go back to 2020. So nobody remembers the last time this company turned a profit. And yet, supposedly, they have $100 million that they just paid back to Ninepoint Partners. Guys, do you think the people investing in their money, do you think the pensioners at the pension funds whose money has been invested in this garbage company, and these are like green energy, like biogas and smart meter companies. These companies are a dime a dozen. They're all startups. None of them make any money. Do you think the people who are invested in this have any idea of what garbage is lurking in their retirement accounts? Most of them probably think their retirement money is safe. You talk to the average person and they're like, well, that's my pension. I work for it. I deserve that money. I don't care. They're going to pay me. Not if they don't have it. Your money is gone. Your money is an IOU to this company that has not made a profit in 4 years. But it gets worse, guys. It always gets worse, doesn't it? Check this out. We got this company, this Ametis company, and look at the name right above it, Protair-X. That's another one of these companies that supposedly just paid back $71.3 million to Ninepoint Partners, to this fund, right? Protair-X and Ametis. And I found this article here. This is from back in, February of this year. Ametis amends biogas project financing terms. And this is one where I was like, what? When I read this, I couldn't believe this stuff. Ametis Biogas LLC, a subsidiary of Ametis Inc., amended its agreement with Protair-X Americas to extend the redemption date for Series A preferred units and increase the redemption price to $111 million. The amendment also outlines terms for the new credit agreement should the units not be redeemed by the new deadline, with a principal of $111 million, a maturity date a year later, and a minimum annual interest rate of 16% or prime plus 10. The move is significant for investors as it adjusts the financial strategy and obligations of Ametis. So not only these two companies, Ametis and Protair-X, not only do they owe hundreds of millions of dollars to Ninepoint Partners, but these companies owe money to each other. Ametis is owed money, or Protair is owed money by Ametis. They owe money to each other, $111 million. And just as recently as February, they extended and pretended. They increased the principal of the debt that Ametis owed to Protair, and they raised the interest rate to 16%. So when you look at this 9-point fund here, guys, not only do these companies owe all of this money that they can't possibly pay back to this fund, but some of these companies owe money to each other. This is looking a little Ponzi-like here, guys. I'm not going to lie. When I see two companies in the same fund owe money to each other, and then you've got this Ninepoint Partners has their fingers all over every one of these pies, this is screaming corruption here. Something is up with these companies here. My God, if your pension fund is in any of this garbage, I wish you guys the best. You really need to get on your companies, guys, your fund managers. If you guys are union, get with your shop stewards and start demanding answers about what is in your pension funds, guys, because Wall Street has been robbing you blind. And, well, luckily, maybe it's not that bad. Maybe these guys aren't really putting all this stuff into pensions, right? Oh, crap. 4 Canadian pension funds increasing exposure to private credit, according to a report. And who is that report issued by? Well, let's read a little bit. This is in benefitscanada.com. As banks continue to pull back on lending, the Canada Pension Plan Investment Board, the Ontario Teachers Pension Plan, the Ontario Municipal Employees Retirement System, and the OPS EU Pension Trust are increasing their exposure to private credit, according to a report by Reuters. The CPPIB, which manages $575 billion, said it will double. $576 billion. Wow, this is a huge fund. It will double its overall credit portfolio to around $115 billion over the next 5 years. They're putting 20% of the fund's assets into this kind of crap. And well, let's see. What else we got here? Private credit has become popular among pension schemes and insurers because it offers higher returns than traditional fixed income products and typically better downside protection than equities, said the report. Indeed, the Ontario Teachers and OP Trust both told Reuters they saw opportunities to plug gaps left by banks and the OMERS, and said it sought the kind of opportunities across credit markets, including private credit, that it hadn't seen in many years. And again, guys, maybe there's a reason why banks won't lend to these companies. Maybe it's because these companies can't pay them back. Anybody ever stop to ask this stuff? And by the way, the value of global private debt assets under management is expected to jump to $2.8 trillion by 2028, according to a report by Preqin Ltd., as well as a recent report by who? By Ninepoint Partners. Same company we were just
talking. The really bad part is about all this, Jack.
Go ahead, Mish. What is it? What is it?
These pension fund managers invested, they're just going to get fired or quit and then walk away. With their $1 million bonuses. We're the bag. These guys, been living a high life for a decade. They're just going to walk away.
You broke up a little bit there, Mish, but I did catch, you're right, that these fund managers, they're going to get their golden parachutes. They're going to go on, work somewhere else, right? They're not going to eat the losses here. They're collecting fat fees, fat bonuses, right? They're getting wined and dined by these fund managers who are parking this garbage in your account. And that, guys, that's got to be the takeaway here. You might be saying, oh, this doesn't affect me. Have you really looked? Have you really looked at your 401k? At your BlackRock, Blackstone, whatever income ETF, and looked at the prospectus and the holdings and seen what's in there? There's a really good bet some of this garbage from Ninepoint is hiding in there. This is not a Wall Street problem, guys. This is a Main Street problem. 100%. Wall Street is pigging out at your expense. And Mish, you're so right. You're describing moral hazard once again. It is so rampant in Wall Street. And we got Cheeseburger sending a super chat here. He's saying, Mish, if Jack swears on stream, does that mean we can all go sailor mode in chat? What do you think, Mish? If my sailor's mouth
I told him no. Nan won't let us.
Yeah, we do have. I apologize for my vulgarity from time to time, guys. I do get heated at the thought of grandmas getting ripped off, and occasionally, I spent some time on a commercial fishing boat, guys. Trust me, I got a sailor's mouth. I tone it down for YouTube, but it's there. Trust me. But let's keep it neat for the ladies, shall we? Let's not let that run rampant too much. But thank you, Matt. I appreciate that.
What's up, 25 years on ships. I spent 25 years on ships. I had to consciously change my words.
Yeah. Mish and I have two different vocabularies. Just so you guys know, you don't get our regular vocabularies here. We turn that one off. We put it in a little box. We lock it up, and then when the stream ends, we take that one back out. Just so you know. And some of you guys, I've met some of you guys at conferences and things in person, and I know you've seen normal, Jack. Trust me, it's a little different. Thanks again, Cheeseburger. And he's saying increasing exposure because they've been caught with their pants down. Abso-freaking-lutely, man. And, the whole point of the rate cuts or the rate hikes of that big interest rate cycle was that, all this easy money over the years created this rot in the financial system. The rate hikes are supposed to put companies like this Ametis, who hasn't turned a profit in 4 years, they're supposed to be going belly up with these rate hikes. And they're not, because they just found a new rug to sweep it under. And that rug is your pension. It is gross. And it's become the norm in Wall Street. Here's this article about all these guys who are like, oh, yeah, we're making a ton of money. We think it's going to be trillions of dollars by 2028. Oh, man. And even Jerome Powell has been warning about this. Powell made a mention about private credit causing problems at one of the last FOMCs. We're going to hear a lot more about this, guys. But you know what? It's not just private credit. We're going to have to start going a little faster here because I got a lot more stuff to get through and I don't want to run too long. Check out this one in the Wall Street Journal just today. Commercial property meltdown clobbers pension funds. They're finally using Jack language here. Wall Street Journal embracing the doom. Finally, where you been all my life, Heather Gillers of the Wall Street Journal? Finally, you're speaking English to people. This is what's going on. Pension funds are being clobbered by the commercial property meltdown, even though somebody in the financial press calls a bottom every day. Government retirement funds are selling property at a loss as the slump spreads. Government pension plans are getting hit by the commercial real estate meltdown, and many fear the bleeding is far from over. Always the Canadians. Why are the Canadian pensions so exposed to this? I don't know. Canada's National Pension Plan said in May that it's selling stakes in a Manhattan and San Francisco office towers for $225 million, less than it paid for them. In April, California's government worker pension fund said it had unloaded a Sacramento property that it had been trying to develop for almost 2 decades. In March, consultants warned California's teachers' pension that office holdings would continue to drag down returns even after a 9% real estate loss in 2023. And guys, keep in mind, before we even get further into this, that all of these funds before these losses are already underfunded. Their liabilities already way exceed what they have in these funds. The moves offer a new glimpse into the widespread and slow-moving commercial real estate slump, because those investments generally don't trade on public markets like stocks. There isn't an agreed-upon price. In other words, no price discovery. When the market shifts, it can take months or years for managers to adjust the value of their holdings. In other words, extend and pretend, exactly what I've been saying for months. Now, 2 years after rates started rising and 4 years after COVID, the impact of those events is spreading from U.S. banks with trillions of dollars in property loans and investments on their books to the retirement savings of teachers and firefighters. And this article goes on for days and days with examples of a different pension fund losing hundreds of millions of dollars on another property and another property. It goes on and on, guys. Commercial real estate is just like private credit. There is no price discovery. It is extend and pretend and park this crap on the balance sheets of your pensions. And by the way, there's this narrative that, don't worry, commercial real estate's only going to affect the small banks. Think again. And this one just yesterday in Bloomberg, big banks' commercial real estate exposure rises 40% when REIT debt is factored in. You know, we've heard a lot how commercial real estate is a small and a regional bank problem. The big banks aren't that exposed, but they're only counting direct loans to buildings. When these big banks have also made loans to real estate investment trusts, and when you count those loans, the commercial real estate exposure for the big banks rises by 40%. Large U.S. banks may be more exposed to commercial property than regulators appreciate because of credit lines and term loans they provide to real estate investment trusts, according to a new study. Big banks' exposure to CRE lending grows by about 40% when that indirect lending to REITs is added, wrote researchers including Viral Akaria, I hope I said that right, a professor of economics at NYU. That's largely been missed in the debate about the risks the troubled industry poses to lenders, they argue. Everyone is focusing on balance sheet loans by banks, said Akaria, a former deputy governor at the Reserve Bank of India. We should not get caught in a blind spot that large banks have relatively less exposure than smaller banks. So again, there's bigger problems in CRE. Extend and pretend. Don't worry, we have low exposure. As long as we don't look at the loans we made to REITs, everything's just fine. And there's a whole other category, guys. I've done a couple of videos about these net asset value loans and how they're basically Ponzi schemes. They're not quite textbook Ponzi schemes, but they are dangerously close to Ponzi schemes. And the net result for the investor is every bit as bad. Check this out. This is from May 23rd, about a week ago. SEC is scrutinizing NAV loans and sublines, the top examiner says. The Securities and Exchange Commission is scrutinizing fund finance instruments, a top official at the regulator said Thursday at a private fund CFO event held in Washington. Dan Fagas, SEC Private Funds Unit Senior Specialized Examiner, expressed concerns over potential conflicts of interest. The instruments, including subscription credit lines and NAV loans, might introduce, as well as over how the instruments might affect fees and asset valuations. The SEC will be trying to understand the instruments from various perspectives, Fagas said. Performance management, investor relations, marketing to finance operations. Private equity managers have increasingly turned to NAV loans and sublines for help, and everything from bolstering portfolio companies to liquidity disbursement to cash-strapped LPs to making additional acquisitions during a fund's holding period. So they're saying that they're borrowing money against their assets, in some cases to buy more assets, which means leverage on top of leverage. And in some cases, they're borrowing money to pay profits to their investors, or the illusion of profits, which is, like I said, entirely Ponzi-like. Their popularity has already created friction with some LPs, and regulators have noticed. Examiners have been asking private funds questions about the emergence of the NAV loan industry and what it looks like for your business. And I'm not going to get too far into this, guys, but they're already starting to find problems. And by the way, a lot of these funds are charging their investors additional fees taking in these NAV loans, when really it should be the fund manager that's eating those fees, because these investors never signed up for these NAV loans when they put their money in the fund to begin with. That's something the SEC is starting to take note of. And the ratings agencies are onto it too. Focus. Ratings firms are cautious in ratifying private credit loans. This one was just a few days ago on May 28th. Banks and insurers are making more requests to U.S. credit ratings agencies for ratings on their risky loans to private equity funds that are secured against the value of their portfolio investments and cash flows that come from them. And I'm just sitting here like, what cash flows? We just went through Ametis and showed they haven't had cash flow in 4 years at least. So far, the response from the agencies, including the top three, S&P, Moody's, and Fitch, has been cautious because the valuation of the assets backing the loans are difficult to assess, as they're owned by an opaque investor base. In other words, there's no price discovery. We don't really know what these assets are worth. And so how is a ratings agency supposed to say how risky a loan against those assets is if we don't know the value of those assets? And even the ratings agencies, which are typically happy to collect fees to rubber stamp something AAA, they are not playing ball here. Lenders are now approaching ratings agencies to get credit ratings on their loans in a bid to lower the amount of capital needed on these loans as an added due diligence of the risk, senior officials said. So these firms are asking the ratings agencies to rate them AAA so it doesn't cost them as much to borrow. The agencies are balancing this fee-generating potential with a methodical approach. In other words, they're saying like, hey, we can't really do this, guys. We'd love to take your money, but this stuff is garbage. How are we supposed to rate this? Only two, S&P Global and KBRA, of the four agencies interviewed by Reuters, rate net asset value loans, which are riskier because they're secured based on the theoretical valuation of an almost fully invested fund. Valuations are much harder to assess in an environment where default rates in the invested portfolio companies are expected to rise as they struggle with higher interest expenses. These loans have a shorter history in comparison to other types, as their demand and wider use rose only in the last few years as exit through asset sales became harder in a higher for longer rate environment. Their volumes are growing. Now, I love this statement. They're saying, exits through asset sales became harder in a higher for longer environment. They didn't become harder. It's just as easy to sell your assets. The problem is, in a higher rate environment, you got to lower your price. And these funds are refusing to lower their price. So they're taking on debt. Instead of doing that, they're adding leverage on top of leverage. Oh, I'm sure this is all going to end so well for the average person. Guys, what they're doing is so unbelievably sleazy. They're not letting these things go down in value. They are lying. They're taking out more debt on your behalf, paying more fees on your behalf, lying to you about what is in your retirement fund. And, you know, it all blew up today for Ninepoint. They had to freeze their cash distributions. But don't worry, guys, you're still gaining interest. The IOU from this company that doesn't make money is just getting bigger and bigger instead of you getting any cash. But don't worry, that IOU from Shithouse Inc. is worth every bit as much, as it's just as good as money, right? Sorry, Nan, I cursed again. Sorry, guys, I didn't mean to do that, but I get fired up on this topic, guys. I want to say thank you.
We're about.
What's that, Mitch?
We're five deep on supers, and check out the Dow. It surged into the close.
All right, real quick, guys, let's check out the Dow before we get too far. Oh, yeah, look at that. Buying in the close by the Dow. That is your portfolio rebalancing in the close, guys. All of those big orders from institutional money, they all got processed at the close. The Dow closing at 38,686, up 574 points. I'm afraid to look at the NASDAQ. Did the NASDAQ drop? No, the NASDAQ rallied too. Look at that. NASDAQ rallying in the close, closing down just 2 points. And the S&P closed up 48. Where did all that buying come from at the close? Good God. That was not portfolio rebalancing. That was institutional money piling in. Check that one out at the end. Might have to dig a little more into that. I don't know what the heck happened at the close there, but yeah, Mish, you're right. 574 points to end the day for the Dow. Good God. I got a few super chats I got to get through here, guys. I want to say thank you so much to Mr. Hunt and Cover, who says, thanks for being real, Jack. You are most welcome. Look, I'm not always right, but I promise you I will always call it how I see it. I won't BS you guys. I turn away most of my money that's offered to me from advertisers if there is even a chance that the money from an advertiser might one day influence my coverage of that advertiser. I don't take their money. It would be nice. I could make a lot more money doing this if I did, but I don't want that conflict of interest. So it's nice to hear that. Thank you, Hunt and Cover. I appreciate that very much. And thank you also to Darren from Suffolk, who says St. James Place. Ooh, an orange ones. I'll buy it. Is St. James orange or is that purple? St. Charles is the purple one. St. James is orange. Yeah. We're talking monopoly here, Mish. Sorry. St. James Place is expected to drop out of the FTSE 100 after shares in the wealth manager fell by 57% in the past year. UK exposed to this garbage too. Great show for the melon heads as always. Oh, so we weren't talking monopoly. We're talking St. James Place. This is a wealth management fund. They fell 57%. Go ahead, Mish. Were you going to jump in there? Oh, no, we're good. Okay. 57%. Is that commercial real estate? Is that what's hitting that? Let me look that one up real quick, guys, because I'm not familiar with the name. I got to tell you. So let's see what's going on with St. James Place here. Let's see. I'm going to get so many monopolies hits. St. James FTSE. Let's see what's going on here. News. St. James Place expected to drop out. Here we go in Market Watch. No, that was 3 days ago. Financial Times is paywalled. Bloomberg. Okay. Sorry, guys. Everything's paywalled here, and I don't want to do a Google search live on the air too much, but I'm guessing commercial real estate is probably playing a role there, Darren. Thank you for the heads up. That's more homework. I got to go research St. James Place, and I just can't help but shout out. I'll buy it anytime I hear it. I'm not buying St. James stock, but I like the orange ones, man. I like to hold that corner after jail playing Monopoly. Mish, we got to play some Monopoly when you're in town, brother. Thank you also to Kevin DeBella. Monopoly and some chess too. He says, I have SIRS in Illinois, minimum contribution 8.5% of gross. We don't pay into Social Security. I moved all my allocation into 100% stock, no bonds, but I'm terrified of a crash. Can't touch the money while I'm employed. Look, guys, I have to throw the disclosure. I don't have the slip of paper from the government that gives me permission to tell you what to do with your money or suggest what you do with your money. The only thing I can tell you is, get in touch with your fund managers, put pressure on them, start asking questions. If you're in the union, get with your shop stewards and start pressuring them. Get your other union brothers involved in that conversation. It's your money. You guys should have a say in where it's going. And right now, the people deciding where your money is going don't owe you anything, right? They're getting paid either way. If they cost you money, they get paid. If they make you money, they get paid. And those guys are incentivized to take risk because they don't take any of the risk. You're shouldering all the risk. It's a moral hazard. Honestly, I can't tell you yay or nay what you're doing there with your pension. Just be careful, guys. Open up those fund prospectuses, know what's in there, and don't be afraid to make your voice heard. That's all you can really do, unfortunately, with this passive investing bubble that we're in. But thank you, Kevin. I appreciate the super chat very much, and I wish you all the best in Illinois there. Tofu Bad Guy says, I'm one of the doomers who already cashed out of the 401k, sitting on silver, which had a rough day, but it's had a pretty good year so far, and positioning for the end of the big scam. Think it will be exciting. I got C3PO in my mind here saying exciting is hardly the word I would use, but yeah, I agree. It'll be exciting. It's not going to be exciting. It's not going to be fun for everybody, but it certainly isn't going to be dull, Tofu. I can tell you that. And all I can tell you guys is the sooner it happens, the better. And, yeah, I'm a doomer. Yeah, I'm a perma bear. I get it. But the longer this goes on, here everybody's saying, yeah, you've been calling for market crash for 2 years and it hasn't happened. Why? Because this bull has been happening. All this crap has been swept into private credit funds and sold into pensions and the extend and pretend. The problem has gotten bigger because the crash hasn't happened. The crash needs to happen in order to restore a healthier market. And all of these delaying actions, all this extend and pretend, and these fake liquidity boosting policies just makes it worse. That's why I want to see a crash, because I can't get optimistic until I see this rot carved out. Until you get the tumor out, it's going to keep growing. And tumor is the best analogy for this crap that I can think of here. But congratulations on your sitting on the shiny. I'm sure your shiny is doing just fine, Tofu Bad Guy. And thank you, sir, for the super chat. And my man Matt is back. He says current reverse repo status, 10-year RN, 10-year yield right now. All right, we got two we got to look at there. We haven't checked on reverse repo because it stopped dropping. But real quick, I'm going to check in on the 10-year. What did the 10-year do in the close? The 10-year closed down 4.8 points, so didn't make a big move into the close. 4.5, pretty much where it was at the start. So no big move in the 10-year. But let's look at reverse repo for a second. 439.8 billion. And guys, I just want to zoom in on reverse repo. Look, it stopped falling. I mean, it hasn't made a meaningful change since the end of February. We had one little dip there in mid-April, right around tax day, and it came right back up. But reverse repo has not changed shape for the better part of, almost 3 months now. So the Fed is still doing their liquidity drain, right? The Fed is still doing their QT. Let's look at the Fed balance sheet. That's still dropping, 7.284 trillion. Right? The Fed is still doing their QT. That's still going on, but the reverse repo stopped falling. What gives? And what's really gonna boggle the mind is check out the M2 money supply. This is M2WNS, the supply of money in all checking, savings, and money markets and CDs. Look, since the end of October, the money supply has been growing. I mean, it took a little bit of a drop there in April, right around tax day, but we're making higher highs and higher lows now in the money supply. So riddle me this, guys. The Fed is still doing QT, right? They're still destroying tens of billions a month, right? 95 billion. They said they're going to lower it to like 60 and change or something like that. But the Fed is still destroying money, and yet the supply of money is growing and the reverse repo isn't shrinking anymore. Is private credit why the money supply is growing? Is that one of the reasons why? Because of all this money that's being loaned into existence against this garbage collateral? Is that why? Is that totally offsetting the Fed's QT? Is Jerome Powell fighting private credit and Aunt Janet over at the Treasury? I don't know. I'll be honest with you. I don't know why the money supply is growing. I think it's time we bring Joe Brown back on the channel to talk about that. When I see something happening with the money supply and I can't put my finger on it, I immediately think to Joe, what WWJB, what would Joe Brown do? Anyways, thank you, Cheeseburger. I appreciate the super chat, sir. And thank you to Matthew, who says, still selling my AAA rated bonds filled with BNPL loans like a boss. How is that even a thing? How could there be AAA rated bonds full of buy now, pay later loans? These people have 660 credit scores and below. And according to some of the research I've read, 40% delinquency rates on these loans. And somehow they've been declared AAA rated. And by the way, while we're still looking at the money supply growth, scratching our heads, BNPL is another possible culprit there. That's one possible reason the money supply is growing, is because these shady banks and these shady fintechs have teamed up to just write these loans without even looking, so people could buy consumer crap that they have no intention of ever paying it back. Maybe that's why the money supply is growing too. All these wonderful ways we have invented to just manufacture money out of thin air. And thank you very much, Clever Custom Performance, for the super chat and the support of the channel. He's a dog. Are you saying I'm your dog, CCP? Looks like a dog emoji. Thank you very much, sir. I appreciate the super chat and the support of the channel. So, guys, look, that's the theme there, is extend and pretend. All right. They're just pretending these assets are worth more than they are. They're borrowing against them. There's leverage on top of leverage. They're afraid of price discovery. They're avoiding price discovery like the plague. They're sitting on assets like this Ametis company, this Protair-X or Protair-X, whatever that company was. These companies that don't make any money, they've been negative free cash flow for years in a row. They even owe money to each other. Supposedly all their debt just matured, and yet this Ninepoint Partners says we don't have any liquidity to pay the interest you owe. But don't worry, you're still making money. Just the principal on the loans is getting bigger and bigger. That money's never coming out of there. No way. No way. These companies are zombies, guys. Nobody buys their products. If they even have products, I didn't look that far. I'm assuming they have products. But even these days, in the days of the AI bubble, that's not even a safe assumption because we've got multi-billion-dollar valuation AI companies that don't even offer a product yet. So how do you value them if they don't even have a product? I don't know. I like the founder. Is that how you value it? I guess. Know what's in your retirement, guys. Know what they've put you in. And remember, you have a say. You may not be able to control it directly, but if you make enough noise at your union meetings, if you start making enough calls to your HR department and start asking them about this crap that's in it, and you tell your coworkers and they start making that call, maybe there's still time to get out of some of this garbage before it blows up. And all these guys, I'm telling you, they're all sitting on this and they're saying, don't worry, because the government will never let these pension plans go belly up. They'll never let them fail. They'll just socialize the losses across the whole tax base. Well, remember, you're also the tax base, guys. So either way, you're going to end up paying for this. And if they do socialize the losses against the tax base, guess what? Your cost of living is going to go up again because they're going to devalue the dollar to do that. And even in that case, that's even worse because, maybe you get your pension cash back, but that pension cash is now devalued because consumer prices went higher. So people need to call this crap out. I'm going to get off my high horse now. Mish, what do you think, brother? Am I missing anything or any parting words of wisdom from the Mystic?
Well, there's always good parting words. Cheeseburger just slipped one in. So if you find yourself in a crowd this weekend, just make sure you have a good exit path lined out.
Yes. Avoid the crowds. Avoid the political nonsense too, guys. It's going to get worse before it gets better. Just hold your nose and wade through it. I don't know how else to tell you. We didn't touch that topic, that thing that is happening, not with a 10-foot pole. Sorry, guys. This is a finance channel. I just don't want to get into that. Cheeseburger's asking a decent question here. El Salvador or Argentina? Look, I like Bitcoin, guys, and I'd love to say El Salvador. Let me just tell you, Mr. Bukele, sometimes he gives me the heebie-jeebies. He got into bed with the Bitfinex and the Tether guys. Those volcano bonds that were going to be backed by this new city, this new Bitcoin city they were going to build next to a volcano. It was going to have all geothermal power, and they were going to sell Bitcoin bonds. That crap is never going to happen. So I would definitively say Argentina over El Salvador if I had to pick one. All right, if I had to pick one. And I wouldn't be surprised to see Argentina follow El Salvador's lead and start accepting Bitcoin as legal currency, or maybe place some of their central bank holdings into Bitcoin. Still waiting for my man Milei to follow through on his promise to get rid of the central bank. I want to see one country do that and just see what happens. And look, Argentina, what do you have to lose? And you guys already have like 50,000% inflation or whatever the heck it was over the last couple of years. What do you have to lose? So at this point in time, I'm going to say Argentina, just because I think they're on a better path, even if El Salvador might momentarily be in better situation. Although I use that term loosely because the gang violence in El Salvador is wicked. Be very careful if you're thinking about visiting that town. Don't get lost in the wrong part of El Salvador. Thank you, Cheeseburger, again for the super chat, sir. And all right, guys, we're going to wrap it up there. I want to say thank you so much for spending your Friday afternoon with the Melonheads. Thank you to Mish and Nan and M&J and all my mods for everything you guys do to keep things neat and tidy in the chat. Days like today, it can be hard. Thank you guys for everything you've done. Thank you for the super chats. Thank you to all my channel members and magnanimous Melonheads on Patreon and YouTube. You guys are so awesome. Have an awesome weekend, everybody. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.